Could breaking your mortgage be the best decision you make today? Well, maybe. And Airbnb properties, yeah, we've all seen it. They've been slapped with HST on the sale. We're going to talk about this and more with our good friend and mortgage broker, Mr. Dion Begg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Begg. How you doing, my man?
I'm good, Gary, but as I jumped on camera today, I realized I'm overdue for a haircut, so I'll have to book one of those this week.
Excellent. I'm glad we can be that social convener for you, or whatever that is. Lots going on.
I should look in the mirror more often, I guess.
Yeah, that's right. That's right. There's been lots going on, Dion, over the last couple of weeks with, the jumbo interest rate cut and the ripple effect from that. And that always generates more inquiries. Am I right?
Yeah. It's been super busy. Lots more people reaching back out. People have been sitting on the sidelines for a year plus. As I mentioned last week, we had a client who, between when we last spoke and today, their payment, if they were to move forward now, would be nearly $1,300 less. So those things are available now. And I think as people slowly realize that, hey, this thing they've been waiting for is finally here. It's kind of, I'm writing an article at the moment saying you can finally get out of your mom's basement, right? So it's like a lot of first-time home buyers have been waiting for rates to drop, and now this 30-year amortization. So I think the new year is going to bring a lot of opportunity, and the people who are ready for that should start to sort of prepare for that now.
Yeah, exactly. And when we're talking, we are starting to see some opportunities, and those conversations are happening, and things are moving forward with that, well, shall I say, cautious optimism, as Canadians like to do. Most Canadians like to be cautious optimistic.
Yeah, I think that's true, and I don't think it's going to all happen in December, but I would say that things are lining up for a pretty good spring market.
Yeah, I think you're right. All right, I love checking in with you over the week and getting your experience and the conversations that you're having, because obviously we're having them on the let's buy, let's sell. Well, we always circle that back to, have you talked with your mortgage broker? And Dion, talk to us about some of the conversations you're having this week. I know we often talk about, hey, sometimes it's good and okay, maybe it's okay to break your mortgage. Talk to us about that.
Yeah, so look, we're at a very interesting period of time where historically, guys, if you take a fixed rate, everybody knows that to break that fixed rate, it usually comes with a very big interest rate differential penalty. I won't get into the mechanics of that, but just know that it's much larger than breaking a variable rate. But in the last week, I was just talking with a client who, during, I guess, the madness that was, these high rates, she locked in on a 5-year rate at around 6.29%. 629. That was the going rate about 18 months ago, I guess. And now she could basically shave 2% off that rate. But obviously she was concerned, like, Dion, I would love that rate, but what's the cost going to be? So we ran the numbers, and yes, the penalty was large. Now, to exacerbate things here, her mortgage size is $2 million, right? Just a little bit over, but we'll call it $2 million for today's simple conversation. $2 million mortgage, and the penalty to break that was in the range of $40,000. So that's a big chunk of penalty, right? But when we ran the math and we looked at a 2% saving on $2 million, right, we're looking at $40,000 in interest saving in just 1 year. So meaning the cost of her penalty would have been made back in just 1 year. And she had 3.5 years remaining on her mortgage. So when we did the math, it was a $40,000 cost for a $140,000 saving. So netting her a saving of nearly $100,000. So in that case, the math is simple. Yes, nobody likes to pay penalties, but if the penalty results in such a huge benefit on the other side, then yes, it makes sense. So I know that's a large mortgage, but that does scale. Let's say that your mortgage isn't $2 million. It's $500,000, a quarter of that, then your proportionate saving might be $25,000, depending on your circumstance. So if you're listening and you have a mortgage that's high fives or in the sixes, now is the time to visit that. And I'll say this is really important, Gary. as fixed rates continue to drop, that penalty will increase.
Mm-hmm.
And so it's actually smart to look at these numbers now before fixed rates potentially drop more and the penalty increases more.
I have a question that I love that because we always got to be assessing where we are. And there's a great mentor out there that we follow. I follow in the Keller Williams world, and that's Jay Papasan. And he said, I should say, we have a financial conversation every month, him and his wife. And
All
that's
right.
where that conversation would come up, right? And I think that's
Yep.
important to be constantly looking at. I do have a question around that though, and I'm curious from your perspective, that borrower or borrowers like that, are you seeing them move into a variable rate, knowing that perhaps interest rates are still going to go down, even though that variable rate might be just a little bit higher than that fixed rate right now?
Yeah. So on a day-to-day basis, and I literally had two conversations within 2 days with two couples who were almost in identical circumstances, and they were refinancing. And the first couple took a fixed rate, and the second couple took a variable rate. Okay. And it often comes down to what, as a couple, they feel comfortable with. And so right now, there is the benefit, and I'll go back to this $2 million example. This particular person is an entrepreneur, business owner. Okay. And by default, that means they're willing to take on a little more risk than the standard individual. And so this person here will be taking a variable rate with the plan to write it down and convert it at a future point, where we would all expect, that fixed rate to be lower than what would be available today. But it is really going to come down to the conversations that either couples have amongst themselves or you have in your own brain. And the thing I keep on saying to my clients is, whatever decision you make today, you have to be at peace with it and do not revisit it like in a year or two, unless there's significant financial benefit like breaking, which I don't think there will be based on the drops that are happening. I don't think that the spread is going to be as huge as it has been now. But the decision you make is one where you can't turn to your husband or wife in 2 years and say, I told you we should have gone the other way, and now you told us to go fixed, and now we should have gone variable. Those are things that you as a couple have to agree today to never say to each other. I'm not a marriage counselor, but this is what I've been saying to some of my clients recently.
That's good. That's good. All
Yeah.
right. Talking about mortgages and lowering that balance. You had an interesting conversation with a client who was saving up to pay down some of that mortgage, and talk to us about that.
Yeah, correct. So I was with a client this week, a new client, and he was approaching his renewal, which is coming up next year. And he expressed his excitement that he was finally allowed to drop $50,000 onto his mortgage, which he had been saving up over the last 5 years, which meant to me that he hadn't fully understood the ability to prepay or the prepayment allowances that come with most mortgages. So I'll explain it simply, and let's use a $500,000 mortgage. Um, Almost every lender in Canada will allow you to have a prepayment on your mortgage. Some of the alternative lenders and privates don't, but most of the major banks and monoline lenders do. That is usually anywhere from 5 to 20%. Let's just use 10% for today's example. So let's say you get a 500 grand mortgage, you have a prepayment allowance of 10%, which means $50,000 a year. And let's say it's a 5-year term. So that's $50,000 a year every year for 5 years. Now, if you were to exercise that prepayment option every year, you effectively pay 250 grand off your mortgage over that 5-year period. This 50 grand is above and beyond, that is on top of your regular payment. Okay. And every dollar of that 50 grand would go to paying down your principal. So when I explained this to the client, he realized that he'd missed out on hundreds or maybe even thousands of dollars of interest savings by saving the money to drop it in one time, when he could have been trickling it in on a monthly basis or quarterly basis, which would have immediately reduced the principal owing and then converted to an interest saving every month. So it's very important that you have those conversations. And I'll just say this, we find that when people get their mortgages from a branch or a bank, I found that they just haven't been explained all these ins and outs of how to pay that mortgage off faster, just because I guess maybe they just don't have the time and or incentive help people pay off their mortgage faster. In my world, your world, Gary, the faster we can help a person pay off their debt is the faster that they can build equity and maybe go and buy their next home or buy an investment property. And so we have major incentive to help a client get rid of that debt faster, but we don't seem to see the same at the bank branch level.
Yeah, yeah, good stuff. Okay, here's what I love. Financial planning in the sense that, we have some properties. Do we exit them now, or how do we exit them, or bring on some family members so they get to enjoy the benefits of owning property and creating wealth? You had some really cool conversations around that over the last week or two.
Yeah, that's right. This week I spoke to a lady who is a single lady in her 60s, retired. She's got her pension. She's doing fine. She has her house paid off fully. And she has 2 rental properties, and she has 2 daughters, both of which are in their 20s, both of whom are working, right? And she's decided that she's going to start her inheritance to them with an early inheritance and a little bit of estate planning by adding each of her daughters to each of her investment properties, effectively giving each property to one daughter. And so I love these conversations because these are people, this is the stuff that in my business I encourage people to build towards over, the course of 10 or 20 years. And this week I got to have that conversation with somebody who took that advice and did that thing and is now in a position where she's transitioning that wealth to her children. I think there's some sort of taxation benefits that she's spoken to her accountants and lawyers about regarding, transitioning that wealth now. But I think that's just a really cool thing for somebody in their 60s to be able to, start transitioning that to her daughters. You know what? They may be a little bit older, given that she's in her 60s. They're probably in their 30s. But yes, it's very cool to be part of that process.
Yeah, I love it. And we all, we often think, oh, we have a property, we've got to sell it to provide some funds to give to our family members or our estate, or let that trickle down. But there are many, many ways to look at that in estate planning. And if you're of that ilk and you're curious of what to do with your property or your portfolio, start talking to great
Accountants, yeah.
accountants, and so you get to understand what that estate planning looks like going forward. There's a lot of cool benefits there, and we're not going to get into it because it's above it's above our knowledge, or at least above my knowledge. But family trusts and things like that. There's all sorts of crazy things that you can do to mitigate your taxes, but from that perspective, but to also to help to help your children. Good stuff. Okay. Let's talk about, we often, when we go and buy a property, we often talk about, okay, one of the first questions that we talk about is, where's the down payment coming from?
Yeah.
And, down payments can come from a number of different sources. Cash is always, perhaps the number one source, but there's ways to leverage that. And it's really, really important. And Dion's going to share a story with us, my friends, about how best to leverage your down payment funds. So let's peel that onion away.
So there's actually 2 stories that came out in the last week or so. So one was a gentleman who he's got a good income. He's got a property worth well over $1 million, and he has a mortgage on his house of about $800,000. And on the side, he's managed to save over $200,000. And when he spoke with me, he said his intention was to use that $200,000 as the down payment on a rental property. And he can certainly do that. That's not a problem. But the thing around that is, and while I'm not an accountant, I'll tell you what many accountants have told me. If you've got $200,000 and you have what we would call consumer or personal debt, including a principal residence debt, then that $200,000 is actually best used to pay down the mortgage on your family home. See, the debt on your family home, the interest that you pay on that mortgage is not tax deductible. And the reason for that is that the simple rule is, if the money wasn't borrowed for the purpose of generating income, then the interest is not tax deductible. So in this case here, what I explained to the client was he was better off taking that $200,000, paying down his mortgage from $800,000 to $600,000, and in doing so, reducing the interest on his principal residence. And then through a line of credit, that's a home equity line of credit, the very next day, he could borrow back out that exact same 200 grand. And now, because the purpose of the borrowing is for the down payment on an investment property which would produce income, then now all of the interest on that 200 grand is tax deductible. So this is a very simple and easy move, as long as you've got the right mortgage product on your principal residence, and he did not. So we're helping him arrange for that. But little things like that, guys, and imagine he's going to own this property for probably the next 10 plus years, right? That 200 grand, interest on that 200 grand will be deducted or deductible for the next 10 years. The interest saving is going to be in the thousands, tens of thousands, maybe over that period of time. So a little bit of knowledge like that is going to save you a chunk of change. So that's one example. Another example, Gary, was there was a client who was going to sell some of his stock portfolio in order to do the down payment on a rental property. And in doing so, he was going to incur something like 43% capital gains tax. Mm-hmm. And so I said, well, you could do that. That's certainly an option. Or we could refinance, get that home equity line of credit on your principal residence, borrow that out at today under 6.5% today. And the choice is, pay 43% in tax or 6.5% in interest. Of course, the interest is the cheaper option. So they're things that, again, when you're dealing with us, certainly we'll get you mortgages, but we'll also give you advice as to our experience around what might be more tax advantaged for you. And of course, double check all of this with your accountant, but this is the way that most of our clients would run those options.
Well, and this is what I love is, both Dion and I would conduct our businesses very similarly, where truly we are advisors. And at the end of the day, you want to be advised on this is a big transaction, or this is a big asset, the largest asset you most likely own. So let's be knowledgeable and ask the right questions. So people like Dion can, get all the facts and making sure that you, the consumer, the borrower, the owner has lots of tremendous different options. Okay, we're going to end on this, but however, we're not going to dive deep on it because neither Dion or I are CRA tax experts, but there is something that came up over the last week, and that's
what's all these tax things coming up today, Gary? What's going on?
I have no idea. I heard a line this past week. I was hosting an online workshop, and the presenter said, as much as we don't like it or like it, the CRA is our biggest partner. And outside of most likely a bank or a lender, they were absolutely right. And the CRA, if you saw the headlines, we know they're going after all the low-hanging fruit, and there's lots of low-hanging fruit over the last several years. And today it brings us to Airbnbs, and you might have saw a tax that they applied HST on the full sale of the amount of the condo that was sold in Ottawa. And, we're not going to dive deep onto it, but we are going to talk about perhaps the ripple effect, or one arm of the government's doing this because they see an opportunity, where the other arm is saying we need to create more, more homes, more rentals, more supply into the market. Dan, I don't know about you, but I see this as, if I own an Airbnb, and that's, it falls right within all the rules. It's 90% of the time it's rented out as a short-term rental. I'm not inclined to sell that property anymore because I'm going to get hit with a pretty big tax bill. And maybe I keep it as a short-term rental. I'm still being taxed on it as active income, or I flip it to a long-term rental, but I'm not really excited to sell it. So we might see less supply come to market from that group of properties. I don't know about you, but that's kind of what I'm seeing.
Yeah, well, we had a similar conversation earlier this year when they increased the inclusion rate on capital gains tax on regular rentals, right? And the intention there was, okay, for investors to end up paying a little bit more tax, which somehow helps first-time home buyers. That's the goal. But, we talked about the consequence of that being a lot of savvy investors will just say, okay, if I sell, I pay more tax, so I will not sell. Instead, I will just hold the property and refinance. And so this is just an extension of that, where, the savvy investor again will say, okay, well, if the government is telling me that if I was to sell, I'll pay a truckload of tax, I won't sell. I'll continue to hold the asset and refinance. And, Somebody I read a long time ago said to me, if you want to get wealthy in the world, what you want to do is read the tax code and reverse engineer the way you operate in life so that you fit inside the tax code. So what they're doing is giving a blueprint to investors on what not to do, and therefore they will figure out what to do, right? And it may not be the result they want, because if it means that these properties don't come to market, then there'll be less supply for buyers to utilize.
Yeah, that is well said. Well said. Just remember, for every action, there's a reaction, and the government, they have great intentions. It's just not always executed well, as we all know. My friend, this has been good. This is today's video, or today's call is more about, preparation and knowledge. And my friends, when you are a knowledgeable buyer or seller, you put your best foot forward. Dion, I appreciate it. Remind us how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Begg.
There you have it. That's Dion Begg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.